According to the Center for Climate and Energy Solutions, renewable energy is the fastest growing energy source in the country. And while renewable energy was responsible for 26% of the world's energy production in 2018, it's expected to nearly double to 45% by 2040. And since the world is still so early in this endeavor, I think there are a lot of opportunities for investors to make a lot of money from it. The only question is how to go about this with the least risk and the safest possible returns. In this video, we're going to take a look at all 10 of the renewable energy ETFs on the market. If you're unfamiliar, ETFs are single investments that hold shares of many different stocks. By investing in the best renewable energy ETFs, we can eliminate the risk of selecting individual stocks and all but guarantee our returns from this growing industry. So one by one, we're going to dig through our options to find the best way to profit from the future of energy. Stick around. Before we get into these ETFs, I want to briefly discuss what a future with renewable energy could look like, because I think this will guide us to the safest ETF investments, and this is the thought process I'm using to begin narrowing down our options. Because the renewable energy industry is still in its infancy, it's very difficult to tell which type of renewable energy will be the most used or most beneficial in the future. There are 5 types of renewable energy that are at play here. This includes biomass, which is any material that comes from plants and animals that can be converted into energy. The burning of wood or crops is a good example of biomass energy. This also includes hydropower, which is the process of using moving water to generate energy and electricity. We also have geothermal energy, which involves capturing the heat that the Earth naturally radiates. Next is wind, which just like hydropower uses moving air to generate energy, often through the use of windmills. And last is solar, which is probably the most talked about renewable energy source, and involves capturing the sun's heat to convert it into energy. These 5 types of energy are considered renewable because they can replenish themselves over time, unlike the fossil fuels that mostly power our planet today. And like I said, I can't predict which of these will lead the growth of renewable energy usage, so I want to make sure any ETF I look into has exposure to each of these energy types. Another thing I want to consider is that not all renewable energy is also environmentally friendly or green energy. One component of the push for renewable energy is sustainability, because eventually we'll run out of fossil fuels. However, I think the more important aspect of renewable energy, and the cause that will inspire the most change, is finding an energy source that won't pollute our planet and accelerate global warming. The reason fossil fuels are problematic here is that they release carbon dioxide and other greenhouse gases when they're burned. Ideally, we'll switch to a renewable energy source that doesn't create carbon emissions. But not all 5 of the energy sources I mentioned fit the bill for this. Specifically, the use of biomass as a renewable energy source causes a lot of carbon emissions. For example, we know that trees absorb carbon dioxide and clean our air, but when the wood from these trees is burned, it releases all of that carbon dioxide back into the atmosphere. Therefore, burning wood and other biomass for energy, even though it's technically renewable, is not much better for the planet than just burning coal or oil. So with these things in mind, here are the criteria I'm using to filter through the 10 ETFs we have available. First, I want to find the ETFs that represent all 5 renewable energy types, with the exception of biomass. This is because I believe carbon-free or carbon-neutral energy sources will be most important and therefore most profitable in the future. But I'm not confident enough to just bet on one, so I want to make sure I have money spread into everything. Second, I want to find ETFs that represent businesses involved in every vertical of renewable energy. I want the businesses generating the energy, storing the energy, distributing the energy, and businesses building the infrastructure to do all of those things. By spreading my investment to everyone involved, I can rest easy that I will see returns from the industry as a whole. Third, I want global diversification, but not too much. A lot of US-based companies have come out in recent months and announced a transition to greener energy in the coming years. And I think as more businesses do this, it's going to accelerate the push for green energy nationwide. And because of this, I want most of my investment to be focused on the US, where I believe we could see the most growth in the short term. But this is still very much a global effort, and I'm definitely interested in seeing an ETF diversify maybe around 20 to 30% into foreign renewable energy businesses. So with all that laid out, let's take a look at the 10 ETFs that are specializing in renewable energy. I found this list of renewable energy ETFs on both ETF.com and ETFDB.com. So if you want to use either of these resources to dig deeper for yourself, I will link them both in the description. First, we've got the iShares Global Clean Energy ETF, ticker ICLN. We've also got the Invesco Solar ETF, ticker TAN. Despite its incredible performance lately, it focuses only on solar energy, so I'm going to rule this one out right off the bat. We've got the Invesco WilderHill Clean Energy ETF, ticker PBW. We've got the First Trust NASDAQ Clean Edge Green Energy Index Fund, ticker QCLN. We've got the ALPS Clean Energy ETF, ticker ACES. We've got the First Trust Global Wind Energy, ticker FAN, which I'm also going to rule out because it focuses exclusively on wind-based energy. We've got the VanEck Vectors Low Carbon Energy ETF, ticker SMOG. We've got the Invesco Global Clean Energy ETF, ticker PBD. We've got the Spider S&P Kensho Clean Power ETF, ticker CNRG. And last, we've got the Global X YieldCo and Renewable Energy Income ETF, ticker YLCO. So we've already ruled out 2 ETFs due to a focus on a specific energy type. Next, we're going to rule out some of the ETFs that are too diversified. I mentioned I'd like to see a little bit of foreign exposure, but no more than about 20 to 30%. So first, we'll revisit the iShares Global Clean Energy ETF. Looking at the country breakdown here, we can see that less than half of the fund is composed of US companies. The fund is designed to hold just 30 companies, but it currently holds 34. And this means just 16 of the companies in the ETF are US-based companies. With so few US companies in this ETF, there's no way I'm going to get the broad US renewable energy exposure that I want out of this one. So with that, we're ruling out this fund. Next, I want to take a look at the Global X YieldCo and Renewable Energy Income ETF. As a dividend investor, I really wanted to like this fund because it's the only ETF that pays more than a 1% dividend, currently at about 3%. But this fund has 2 problems in my opinion. First, in order to provide this higher dividend payout rate, it only invests in companies that yield above 2%. And my assumption is that many of the leading renewable energy companies out there are not going to be paying dividends. This is so that they can instead focus on growing rapidly and accommodating the evolving energy needs of our country and the world. So by strictly investing in companies offering more than a 2% yield, I think this particular ETF could miss out on some of the highest growth opportunities in the industry. The second problem is that the US companies only make up 18% of this fund. With just 37 holdings, only 7 are US stocks. And again, I want more US exposure in my portfolio, so this fund is out. The next fund that falls a little short for me is the Invesco Global Clean Energy ETF. This fund is doing a little better than the previous ones with 86 current holdings. But again, just 30% of the fund holdings are US based, and it's required to invest half of its holdings internationally. Additional red flags for this fund are that it has the highest expense ratio of our remaining options at 0.75%, and it's lagged behind its benchmark index since its inception. And I think the reason for this is that although it's technically passively managed, it does have an actively managed component. The companies selected for this ETF are based on the management team's opinion of potential capital appreciation. So while other ETFs we're looking at are using a pure indexing approach for their holdings, this one has the added risk of the involvement of the fund managers. For these reasons, I'm ruling this one out. So we're already down to just 5 ETFs, and the remaining options are all fairly similar. All the ETFs we've got left are pretty heavily weighted in US stocks, so it looks like we're not going to get quite as much international exposure as I'd hoped. But I think we'll be better diversified among the renewable energy space for it. So now I'm going to take a closer look at each of these 5 ETFs to see how each fund's holdings relate to the renewable energy industry. We're going to start with the First Trust NASDAQ Clean Edge Green Energy Index Fund. This ETF includes a broad list of businesses involved in clean energy and stipulates that they must be manufacturers, developers, distributors, or installers of advanced materials, energy intelligence, energy storage, or renewable energy generation. So this sounds pretty spot on with what I wanted to see in terms of diversification across the industry. Plus, with 45 holdings and about 80% exposure to the US markets, this has some good things going for it. But after taking a look at its sector breakdown, I'm not feeling so confident. Now I'm going to get on my soapbox for a minute here, and this might be an unpopular opinion, but I think this ETF is too heavily weighted in electric vehicles. You can see that nearly 25% of the portfolio is auto and truck manufacturers. In fact, nearly 11% of the portfolio is NIO, with 6% made up by Tesla. Don't get me wrong, I'm super excited for the possibility of electric vehicles, but I think electric vehicles are highly overhyped and overvalued right now. They definitely play a big part in a renewable future, but the renewable energy industry is so much bigger than just transportation. Furthermore, electric vehicles aren't even carbon neutral right now. The production of electric vehicles actually results in more carbon emissions than the production of a traditional gas-powered engine vehicle. I actually made a video on this exact topic on a different channel if you're interested in the environmental effects behind electric vehicles. But I think electric cars still have a ways to go before they're realistic and efficient options, and their stocks are too expensive for what they currently offer. Plus, I think many of the leading auto manufacturers will be able to adapt and produce electric cars in the coming years, which will lessen the market share that we see brands like Tesla working towards. In short, QCLN is too heavily weighted in electric vehicles for my taste, so I'm passing on this one. Up next, I want to take a closer look at the VanEck Vector's Low Carbon Energy ETF because it has similar issues to QCLN. The portfolio is on the smaller side with 31 holdings, and it stipulates that any company in the fund must generate at least 50% of its revenue from alternative energy. And this results in a much broader pool of companies than sticking to companies that are entirely focused on alternative or renewable energies. So taking a look at its sector breakdown, less than 30% of the portfolio is actually in the renewable energy sector, which is definitely a little lower than I'd like. Again, we're seeing a decent percentage allocated to auto and truck manufacturers, and while I'm a little more accepting at this percentage, I don't like that this only seems to include Tesla and NIO. The other two big allocations in this ETF are to electrical components and semiconductors. I'm definitely not an expert on either of these sectors, but my concern is that since the underlying businesses only have to earn 50% of their revenues from alternative energy sources, then these more technical companies might not be entirely focused on renewable energy. For example, one of the biggest holdings, Microchip Technology, offers so many different products I can't figure out what their goals actually are, and very few of these products even make a mention of renewable energy. Overall, I'm worried that SMOG is not focused enough on the companies that are really going to matter at the core of renewable energy. Its small portfolio is also quite top-heavy, with its top 10 holdings representing 2/3 of the portfolio. For these reasons, I'm ruling out this ETF. So now that we're down to just 3 ETFs, I think we're left with some pretty well-rounded options. So I'm going to go through the remaining ETFs in order from my least favorite to my favorite and give you some of my thoughts on what we've got left. So first we've got the SPDR S&P Kensho Clean Power ETF, which is coming at my number 3 choice for a renewable energy ETF. It has the lowest expense ratio in the category at 0.45% and 40 holdings. The main thing I found interesting with this fund is its methodology for selecting stocks. It uses some sort of artificial intelligence to scan the formal documents and filings of companies, searching for key phrases and terms. I imagine this is something like using Command F on a document and typing in renewable energy to see how often it's mentioned. So if a company mentions one of these key terms enough times, they'll be included in the index. But this includes companies who are both core and non-core players. Core stocks will have renewable energy as their central focus and will be weighted more heavily, while non-core stocks will not be entirely focused on renewable energy and will have a lower weighting. So as we saw with some of the previous ETFs, while the underlying companies may be relevant, they may not be entirely focused on furthering renewable energy. I think this will result in a portfolio that's too broad to benefit fully from the growth of renewable energy. I also found this awesome website called fossilfreefunds.org, which I'll link in the description, that analyzes ETFs and other funds for their compatibility with environmental concerns. After putting in CNRG, this website spit out some awful ratings based on its underlying holdings. I dug a little deeper and found that the high carbon footprint of this fund was due to a number of utility holdings. The issue is that many of these utilities offer traditional electricity services, including generating electricity through burning coal and other fossil fuels. But these utilities are also committed to increasing their use of renewable energy. So currently, these holdings aren't carbon neutral, but they do seem to be shifting towards greener energy. And for that reason, they may be able to benefit when they are able to derive more of their energy from renewable sources. Ultimately, these holdings aren't super problematic, but they highlight a difference in this fund from our remaining 2 funds. CNRG's utility holdings are long-standing businesses that are working to transition to renewable energy. In contrast, our other funds hold companies that were founded on and built around renewable energy solutions. So while I do think CNRG's utility holdings will be able to transition and thrive in a changing energy industry, other funds may be more exposed to businesses that could be disruptors with high growth potential. Overall, CNRG has a nice low fee, but a questionable methodology that I think might distract from a focus on renewable energy companies. Plus, its utility holdings don't really align with a carbon neutral portfolio, which I think might slightly limit its growth potential. Unfortunately, this ETF isn't even available on M1 Finance where I will be investing, so I don't know how easy it is to find elsewhere. Luckily, I'm not too in love with this one. Coming in at my number 2 renewable energy ETF is the ALPS Clean Energy ETF. This ETF focuses on companies involved in renewable energy sources and clean energy technology, but it only includes companies listed in the US and Canada, so it's going to lack any of the global exposure that I wanted. It's also on the lower end with just 36 holdings, but with a clear methodology for selecting the underlying stocks and capping each one at 5%, I think it achieves a sufficiently diversified portfolio. I don't have much to complain about with this ETF other than the fact that its dividends are taxed as ordinary income for some reason. But this isn't really an income-oriented investment, so that's not a huge deal. Ultimately, I just wish it was a little more diversified, and that's what cost it the number 1 spot. And that means at number 1, we've got the Invesco WilderHill Clean Energy ETF. It's on the high end with a 0.7% expense ratio, but it's got 48 underlying holdings that are diversified right where I want them to be in terms of international exposure. I think its electric vehicle manufacturer exposure is just about perfect compared to previous ETFs at around 13% of the portfolio. Plus, the weight of each stock in the fund is pretty similar, so you almost have an equal weight investment in all of the underlying assets, eliminating some of the unusual weightings we saw in previous ETFs. I also really like that the ETF is focused on more of these small cap, high growth potential companies that could deliver serious returns in the coming years. And lastly, it has a really clean environmental analysis from Fossil Free Funds, which assures that they are selecting truly eco-friendly companies with their methodology. So overall, PBW has just about everything I was looking for in a renewable energy ETF, and it's the fund I will be investing in moving forward. However, I'll probably limit this investment to a pretty small portion of my portfolio, and I'm currently thinking about 5%. I do believe renewable energy is important and will continue to grow in the coming years, but I know some of this also comes from my personal beliefs, and I don't want to overinvest in this industry just because it's what I want to see happen in the future. After all, the price of nearly all of these funds has been completely flat for the last decade, if they've even been around for that long. The ETFs that are delivering 100+% returns have only done so in the last several months, and that could all be because of political or environmental events that have created temporary hype and discussion around renewable energy. It's entirely possible that these funds and their underlying stocks are hugely overvalued. So I'm trying to keep a level head despite being really excited about what renewable energy could bring to our planet and hopefully my finances. I guess time will tell, but let me know how you guys are investing in renewable energy in the meantime. Are you taking an ETF approach, or are you sticking to individual stocks in the category? I'd love to hear your take in the comments. And if you want to see more investing videos like this, make sure you subscribe to the channel, and I will see you in my next video.